I don't want it anymore. I've had it like 3 times.
Ugh,
I've had the A, B, and C version, you know. So
I didn't even know there were so many versions.
Oh,
yeah, the
I'm
Delta
a firm
variant was
believer
the
in just
worst.
act like nothing's happening and you'll do a lot better.
Yeah, yeah.
It's called denial.
Yeah, just
I do it, and then I am respectful and I stay home because I'm like, well, if I do have it, but then every time I end up testing because everybody around me is like, you shouldn't, and I'm like, oh geez, okay, fine. I mean, I'm just gonna confirm it for you. Here you go.
Yeah.
Well, if you have it, you should go get an IV. That's like my biggest thing is get hydrated first. Make sure like somebody can come to your house and do it, just so you don't
Yeah.
get.
And
doesn't
quite
prolong.
honestly, I didn't have it bad. To me, it was like having a cold or, you know, the flu. It wasn't anything. It didn't, I had a fever for 2 days, you know, and I had the cough, and the cough was probably the worst part because you don't sleep at night. But other than that, it wasn't horrible.
That was it. Oh, I guess we could totally start. So might as well get this ball rolling so everybody can get back to work. Welcome everybody. I'm Jessica with Team of Title. I've got Andy Price with Price Mortgage coming on to talk about maximizing, you know, the benefits as a buyer on what you can maybe get paid out of pocket, not your pocket, but on the seller side. So I think it's important to know what your options are and what can be covered, and, you know, kind of go from there. And
yeah, this is
maximize
100% about using realtor commissions to help your buyers.
Yeah, right. This is about using your fees.
You'll love it. It's a great
Yeah.
info.
Not.
No.
All right, so yeah, let's get started. There's Jessica.
There's me.
There's me. Dun, 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 dun.
I'm gonna go off camera actually.
There's us.
There's us together. Oh.
All right, so we'll oh, here we go. Okay, so current rates, these fluctuate here and there, but as we can see, we're doing pretty good being in the 5s. You know, we'd love to see them get lower, but I feel like, you know, people are okay with this stuff. When it was 6.757, it was a lot more to bite off, right? And then when you couple that with the buy downs, it really helps the consumer. And, you know, just so you guys know, when you're qualifying for a loan, they don't qualify you off the buy down rate. They qualify you off the full rate. It's a subsidy account. It just makes the payment lower for those 2 years. There are 3-2-1 buy downs as well. That's just a lot of money that you need in concessions to make that work. Buyers can pay it too. It's just, you know, it's kind of pointless because they're already like they're paying it anyway. So it's kind of like they pay a bunch of money up front to have a lower payment for a while. So usually it's something you want to use concessions for.
Hey, Andy.
Yeah.
Just real quick. So when you say you need a lot more in concessions, like up to 6% to do a 3-2-1?
So yeah, that 3% spread is big. So usually if you're doing a 2-1 buy down, depending on the loan size and the purchase price, because it's based on the payment. So as like if they're putting a lot down, the percentage is lower because again, it's based on the payment, which would be a lot lower if they're putting 20, 30, 40% down. But give or take, it's usually going to fall somewhere between 1.75 and like 2.25 for what's needed to do a 2-1 buy down. To get it to a 3-year buy down, it almost is like a whole nother 2%.
Okay.
Yeah. So where that gets problematic is like conventional. If you're not putting 10% down, you can't ask the seller for more than 3%. Like that's all you can get, including the buy down. So that's not going to work, right? Unless they're putting a lot of money down. So if they're putting the 10% down, you can get 6, and you know, maybe a seller might do that. They might give them the 4 or whatever's needed. And if they're putting 25% down, you can get 9%. But again, that's pretty far-fetched to get even in this market. VA is more feasible. Like a VA loan, you can basically, it's pretty much unlimited. There's 4% max on certain things, but things like buy downs and stuff, it can go above and beyond. So VA is an option where you could do it. Jumbo, we have one investor offering the buy down programs, and just like the better jumbo stuff, but the rates aren't really good, so it doesn't really make any sense yet. We do even have some on non-QM products. So they'll even like a couple of the investors are doing 2-1 buy downs on rentals and things in the not conventional space, like for people that are okay with the higher rates and they don't want to verify their tax returns. They want to use bank statements to qualify. They want to, just go off the market rent, what we call the debt service coverage ratio loan, DSCR. So there's options there for 2-1 buy downs, which could be really good for certain guys who are going to want to buy a rental, but maybe that payment's a little too steep for, at first. So it gives them a little time. One of the products that's been sticking out a lot for me is one of our investors has a very well priced 10-year fixed ARM. So that's 10 years of the same rate. And it's, as you can see on this chart here, it's about 0.5% lower than the conventional 30-year rates. So that's a very, great loan. We've seen several people kind of opt for that. 10 years is a long time to have a rate. It doesn't adjust till after the 10 years. So that definitely helps. And when we're talking about, like today, we're talking about maximizing your buying power, like something like that helps, right? Like someone who's trying to get a conventional loan, and let's say they went to Fairway or wherever, or their bank. Let's say the rates for those places are 6.25, 6.5. Well, if we're at 5.75, or we put them in a 10-year ARM at 5.25, that increases their purchase power. That either helps them have a payment they wanted at the price they're already at. It makes them like be more apt to be like, yeah, let's do this. Or it lets them buy more house than what they would have been qualified somewhere else. That's one of the big things, is just rate in general. The lower the rate your customer can get, the more house they can afford, right? And then the other side of that is debt to income ratio. So a lot of the banks, mortgage companies, they have overlays on the debt to income ratios. So maybe on conventional, they just won't go over 45%. Well, we don't have any of those overlays. So conventional, if you can get the underwriting agent to approve it, you can go up to basically 50.4% back end ratio. That could be the difference of someone getting another 30, 40,000 in house or not getting it. So those are things that can help people. Same with FHA loans and even VA loans. There's places that on a VA loan, they may say, hey, we're a hard stop at a 50% DTI or 55. With VA, it's based on residual income. So there's times we'll run a VA loan and it's maybe a 65% DTI, debt to income ratio, and it'll go. And we have lenders that are fine with that because it meets the residual income requirement. So they might be getting told no, and they can't go any higher. And then over here, we're bumping it up 50,000 or 100,000, So second opinions are always good, especially if the customer's not super happy with the terms or just not the pre-qual amount, things like that. FHA, same thing. There might be places, lots that say, hey, 50% max or 55, most are 50. You can go up to 56.99 with FHA if it'll take it. So all those little things where you couple a lower rate with a higher allowance on a debt to income ratio can create quite a big spread in how much they can qualify for. So, there's lots of options out there and we shop them. We're wholesale. So for us, there's a lot of times where we're able to tell these people, yeah, you can definitely go higher than what they're being told. And that really helps in the market we're in, or any market really, right? It can make the big difference in what they're buying and homes you can show them. It helps you be able to have more of a pool of homes to show your customers. So, those are all things to keep in mind when you're working with your customers on things like that. And
Sorry,
go ahead.
I would say, how early do you think people should be getting pre-qualified? I know that's like a big question right now, rather than being like, oh, I need to look for a house tomorrow, but they don't really even know, maybe even what their credit looks like. Like, what do you recommend timeframe wise?
I always say as soon as you're, ready to start looking at houses, or if you think you're going to be in the next 3 to 6 months, it's never a bad idea to see where things are at and make sure like it gives you time, right? Like, hey, you need to work on a few things on your credit. Hey, you need to like make more money, or hey, you need to file that next tax return if you're self-employed, or hey, you need to save up a little more money. There's many things that can factor into if they're ready or not. And the other side of it, which, I think just starts off on the wrong foot. A lot of times people are, they don't want to give the docs. They don't want to do that. And they want to look at houses and they think that, oh, I can, go up to 600,000, no problem. And the realtor's showing them homes for 600, finally get the docs and all they can do is 500. And they had their heart set on a $600,000 house. And now they're sitting in the $500,000 houses. It pretty much takes deflates the balloon, right? Like it's disappointment. So the sooner that they find out what they can actually qualify for, they're not going to get excited about like on things they can't even do. You know what I mean? And also payments, like they may not have any idea what the payment's going to be. They're probably clicking on a house on Zillow and they don't look at the fine print where it's like, yeah, 25% down and da 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 da. And they think, oh, that payment's going to be fine. And then they find out, hey, I'm doing 5% down. My payment's nothing close to that. So the sooner the better. A lot of people know or have an idea if they're going to have an issue. Some people have no clue, right? So it's just all about that educational piece, but definitely always say, hey, the sooner the better. Like the more you're not rushing something and you have time to work through things and just get everything good, it just makes the whole experience once they do get under contract a lot better versus scrambling, for everything and making quick decisions and not maybe having every detail that's needed. So a lot of them do come in scrambling and that's fine. But the ones that do stuff earlier on, it's always a much less, less stress for everyone involved. Any questions on rates or anything? No. So these are just some slides kind of talking about brokers and mortgage bankers. A banker would be, and a lot of them call themselves brokers, but most of them they're pass through just like a mortgage broker, like we are. The difference is they're basically adding a lot to the margins on the rates to cover overhead for like the big offices, the underwriting staff, all the teams, all the branch manager, regional managers, all these people that are taking a piece of the pie. So what really happens most time with a mortgage banker, the loan officer isn't really making a lot of money on these deals. They're most of the money is staying with the lender and all their expenses, and very little goes to the loan officer. So the loan officer kind of loses as well as the consumer, because the consumer and the loan officer aren't really getting any extra benefit in that model. It's all it's really doing is just costing a lot of unnecessary money to do a transaction. Makes it more expensive to get a loan, so they have to do higher rates, have more fees. For us as brokers, loan officers in the broker space, we're paid well, but we also don't have all that overhead, all those layers of management, all those things. So it's a lot less that it takes to operate and to close a loan. So basically, for us, it puts the consumer first and that's what we want. I mean, we're all pretty much referral based for the most part. So when you get a referral, you want to be able to come in with a good offer for people, be better than 90% of the ones out there. I mean, they might click on some random, online lender, who knows how that'll go, and they might change things on them, but we're always going to give them very realistic terms, and we're going to be better than most that they talk to. We see it all day long. I mean, I get quotes from people all the time, and it's just absolutely insane, especially for your VA borrowers and FHA borrowers, those, and USDA too. Any government loan, most of the time the banking mortgage companies, they have a lot more fluff built into those. That's where they make most of their money, and not on the conventional side. So the rates a lot of times for them are going to be same or even higher than conventional rates, when in reality those government rates should be considerably lower. So we're going to always be able to save any vet, any FHA borrower, USDA borrower a lot on rate and a lot on cost, and again, that helps them buy more house. But yeah, these types of places, they either have one rate sheet, they don't always get to pick who. They might have a few different lenders that they sell to, and there's a lot more liability on their side. So they're underwriting the files in-house. So what happens is they have to be a lot more conservative on how they do that, because they want to be able to sell it to maybe on their warehouse line. They might have 3 or 4 places they may want to go. So they want to be able to sell it to any of those in case. So they're going to always be a lot more conservative. On our side, we're going right to the source. They're underwriting the file, and that's that. So again, all the overlays, all the stuff they're worried about, like these guys are worried about getting a loan bought back. We don't have that concern on our side. So they're always going to be a lot more conservative in most cases than we can be. We can be a lot more aggressive on those types of things. And then, yeah, I mean, consumers, we're all consumers. We all want options. I mean, customers should definitely, make some calls, shop around, but when they're talking to us, we're going to look at over 60. I mean, we have well over 60 investors now. We're going to look at all of them. We put them in a pricing engine. We price a loan out. We can see who's going to give them the best terms, who's going to meet the deal. Like if there's weird things going on, or maybe it's a quick close and we know like, hey, this bank has a little bit better rate, but they're probably not going to make the close date. So we kind of base how we pick the loan, where it goes off of that. Then the other side is when you only have a few products, like that's really all you have. Well, on our side, there's countless things we can do for people. So it just helps us be able to say yes a lot more and not no, right? And so, hey, you can't do that type of loan, but you can do this type of loan. So consumers are getting more savvy. They're understanding kind of those differences more than they used to, and they're online, they're researching. There's a lot of info out there, and a lot of times, there's realtors that will push a certain mortgage company that isn't a broker, and then that customer isn't really liking what they're getting, so they're shopping, and then next thing you know, most of those referrals are not going to the lender you work with normally. So now you're working with all these different lenders. You don't know how they're going to perform. You don't have a relationship with them. And just like a title company, it makes a big difference, when you have your team and you know what's going on. So that's where you can lose control, right? Or hey, maybe
I
that other place is like, hey, you should try this realtor out. They might
mhm.
try to dish them off to somebody they know, and that's when you lose that control.
I missed a couple questions from the chat, and Daryl asked, will a 10-year ARM work with investment homes or second homes?
That's a great question. You can do them on those, but the rates, they're not very good. As soon as it flips from a primary, it's really not better. So you're better off with the 30-year fixed
Okay.
on
And
those
then
ones.
the other question was, why is the APR so high on a 10-year ARM?
So we just do that just to be safe. The ARM, since it's not going to fix for 30 years, at some point they assume a really bad adjustment at the end when the 10 years is up. So that's why it looks so bad. But other than that, it's really not. It'd be really similar, really close to what the actual rate is. So any ARMs you see are always going to have a very high APR because they're factoring like the rate jumping up 5% at some point, which wouldn't happen, but that's how they have to do it worst case. Was there any other questions in there?
That was it.
Okay. So yeah, the other thing about buying a house is, interest rate, very important. Also fees, right? So some people are very limited on the amount of money they can bring in to close or how much they're getting from the sellers. It can make or break a deal. When working with us, automatically people are going to save $1,500 to $1,800 in like underwriting fees, processing fees, application fees, admin fees, all those what we call junk fees. So we don't have any of those. So anything they're paying is, if they're paying something, is usually just for an interest rate, and that's for them to have a better interest rate. It's not just to, give us money, basically. So that's a big plus. And then also, these lots of different options and all kinds of financing, short-term rental financing, the bank statement loans, asset depletion, where you qualify with assets that you have, reverse mortgages if those come up. And also we're dealing in the wholesale space, so we're dealing with wholesale interest rates. It's not like there's a lot of fluff added onto that stuff. It's really a good model because we have our expenses as a company, but then we broker to these massive companies that do lots of loan volume, and they have underwriters and stuff too, but they're doing so much more loans than a small branch in Arizona can do, that cost is much smaller to do a loan. So that's where we save money, they save money. When everything's like in a one branch office with 10 LOs, that cost is much higher to underwrite, to do all those things. So that's one of the biggest reasons you'll always see retail lenders, not being as competitive. And also a lot of the lenders that we work with, there's different mortgage insurance rates. So some of them have special agreements because of the amount of business they do where the rates are lower. So that can also help with payment quite a bit. And then again, yeah, we're basically, we're not here trying to just, make sure all the loans go to one place. We're shopping for the customer. We're like, what's best for you? And we don't have to worry about just one option or two. Like we have lots and lots of places we can check with to make sure the customer's getting the best deal. Yeah, you can see right here, yeah, these types of things. So let's see. Yeah, there was actually a thing done where they calculated all the money, like it was some kind of I don't remember who did it, but basically they looked and they saw, there's a true savings to customers working with a mortgage broker versus a retail lender. And you can see like right here, like this was the average savings for all borrowers, and then minority homeowners or borrowers a little bit more. So it's a big deal. Yeah, and pretty much anytime new programs come out, we get them right away. It doesn't have to go through, a bunch of management or updating a system to get things available. When things come out, we have them. Yeah, I mean, these are all we can find the right lender. And yeah, we're definitely referral based. Yeah, we have like 60, 70 now that we lender partners we work with. And yeah, we don't have any like application fees or anything. We're not trying to hold anybody on the hook. We're just trying to help them out. Yep. So definitely we work for the client, not the bank. These are just some of the different places that we send loans to. There's countless more. A lot of times you'll see UWM. They're the number one lender in America right now. They actually did more loans in the last couple of quarters than Rocket Mortgage Quicken did, and they're strictly wholesale. We really like working with them. They're very fast. They're a great option. A lot of broker shops now, especially the newer ones, they maybe have 1 to 5 options on this list. And I mean, these are just some of them, but most of the time, because they're limited on support staff and things, and the way that the UWM process is, it's a very simple one for a loan officer or a one-man shop. So most of the time they're just like a net branch of UWM. And that's fine, except that UWM, their rates go up and down. Sometimes they're not the best. So for us, or for me anyway, I'm always looking at everybody. I'm not concerned about on our side, if it's a little more work, the customer won't notice a difference. It's really just they're easy for a loan officer to use. And they're usually pretty good. Sometimes they're not. So we're not like everything has to go to one place. And that's how a lot of places do it, even in the broker space these days. A lot of guys have come from retail, opened broker shops, went to work for broker shops, and they just basically send almost everything to UWM. But there's so many other options out there. And a lot of times there's better priced options depending on the day. And this is kind of a scary thing. 47% of home buyers don't compare lenders. So if they're not comparing, at least if they're talking to us, we're checking for them over 60 places. So at least we're doing some shopping for them. But a lot of times they don't, it's a hassle, oh, I don't want to apply again, or I don't want to get my docs again, or whatever. But it can really be a big difference in what they can pay and the savings involved. But yeah, I mean, you can see some numbers here, like the savings compared to like a 6.25 versus a 5.75. And I would say most of these retail guys right now, they're probably even a little over that. And for the most part, when you compare, like a lot of them are charging pretty hefty premium, like discount points and stuff to get them in the 5s or in the low 6s. Whereas for us, it's pretty minimal. Yeah, and this is a little bit one of the other things that you can leverage for customers. A lot of people, they don't love that payment. And so basically to help have your customer have more purchase power, we can do a 2-1 buy down, and those are great. I mean, we explain it, and it's definitely something you got to go over with them, make sure they understand, like, hey, the first year it's this, the second year it's this, and then on the third year through the 30th, it goes to this. But it really helps people, not have to bite off as big of a payment at first. And the way things are headed with the recession and all those different things, rates will get better at some point. And the best part about doing a temporary buy down, in my opinion, is if they did refinance in a year and they had 1 year left, any of that money left in that subsidy account, say it's $3,000, $4,000, whatever it is, that's going to go towards their principal payoff, so they don't lose the money. But of course they can stay in this as long as they need to. And if rates get worse, at least they had, some time there where they had a lower payment. But, the odds are they'll be able to refinance and get those down at some point, well within that 2 years. Yeah, there's just some more about that. And then again, on our website, there is that, if you go to our website there at the very top of the page, are you guys seeing that?
Yes.
Okay, right here at the very top, there's a rate buy down calculator thing here. So you can put in, if you're doing a 2-1 buy down, what the loan amount is. You can put in whatever rate and you submit it, and it'll give you basically how much you need to get for concessions from a seller to do it. And then at the same time, there's also this little seller concessions cheat sheet. So you can see how much you can, the most you can ask for on different types of loans.
That is awesome that you have that on there. Okay.
Yeah,
That's kind of
so
what
this
I
is
was
a good
thinking too, like what
resource.
other things can they have? Okay.
Yeah, so this is a very, good thing to kind of reference on the fly if you need to. It's just on our website, pricemortgage.com. Plug in the buy down, check your concession guide. I mean, I'm always here to answer it too, but if you need to do something quickly, this is a great resource. Okay. So what did I do here? I think I screwed it all up. How do I make it full screen again? Well, that's okay. So yeah, if you guys ever need any flyers for any of your listings, give us a day. We can get one done for you with the buy downs and things on there. Some to have available on your listing or in the house. Also, we have a home buyer's guide that we put together. So it has like all kind of a breakdown of different things about buying a home. So this is really good for your first time home buyers, especially. So if you'd like to get one of these co-branded, just send us an email and we can do that for you and send one your way, okay? It's a really, really awesome guide for home buyers.
I like that.
Yeah, it's awesome. It's been really, we just came out with it a few days ago and it's pretty neat.
Yeah, I feel like because this is kind of the most complex piece is your mortgage, because it
Yeah,
kind of
and
goes with
think
you. I mean, I
we're-
understand the house, but
I think we're going to see, a lot of these first-time home buyers coming out of the woodworks right now, and you want to be able to give them things to digest, to understand the process. Other than just reaching out to you and me, it's good for them to kind of have something to reference. But yeah, those are ways we're helping customers maximize their purchase power, helping you maximize your customers' purchase power. If there's anything you need from us, just let us know. We're always happy to help. Is there any other questions or anything that people are seeing or have questions on right now?
no, I always just look at ask. It doesn't hurt to ask, right? When you're writing a contract, especially on those homes that have been listed a while. So I was like, hey, ask for what you can get. They might take it. It's better than lowering their home value. That, hey, yeah, sure, I'll pay for X amount of closing costs or the buy down.
Yeah, I mean, number one, you might have customers saying, let's go low, low, low on the price. I would always recommend, if you want to go in low, that's fine, but add on concessions to your offer, bump it up to cover it, because those concessions will make them a lot happier on what they're paying to close, what their payments will be if we put it towards a buy down or just lowering the rate in general.
Just less out
So
of pocket.
yeah, so concessions are huge. It makes it's way more beneficial than lowering the price 10,000. That's $50 a month, and that's great, but the money they can save in payments and all those things is a lot bigger, and it makes it a lot better for them, for your buyers. Yeah. But
What
yeah, well, good
about,
stuff. We'll keep these going. We just took a break for the holidays. I think next time I might go over some condos and where to check things on FHA, USDA, stuff like that. Or if anybody has any suggestions or things that they want to
Let
talk
us
about
know.
next meeting, please let us know so we can touch on those topics for you to make
I
you
think-
guys, superstars and
Yep.
make you dangerous out there.
Holly, did you have a question?
I did. I just wanted to know if you're dealing with HELOCs or bridge loans at all rather than doing consignment.
Yeah, we do have there's bridge loans out there. There's HELOCs. We can do HELOCs. The ones that if they're really well qualified and they don't have a very high loan to value on the HELOC, most of the time they're like, I think Desert Financial has what we call a promo or teaser rate. So does Comerica. There's a few others. So some of these banks will do it because right now on a HELOC, the prime rate that they base them on, there's a margin plus prime. Prime is at 7.5%.
Okay.
So a HELOC
Yeah.
rate is going to be 7.5 plus some sort of margin, depending on credit score, depending on loan to value. So most of those rates are going to fall in the 8s, 9s, 10s, right? So it gets pretty pricey. It doesn't mean that they'll have it a long time. It's maybe not a ton of money, but it is a higher rate. If they go to one of those places that do a teaser rate, some of them are doing like a 4 or something, a 5 something. It's for a year, maybe 6 months, but it does allow them to have some savings on that HELOC side. As far as bridge loans go, your traditional bridge loan is usually going to cost anywhere from 2 to 4% in fees. The rates are going to be anywhere from 9 to 12 to even higher percentages. And they're not, it's not a great loan. one of our investors, if we send them the mortgage on the purchase, they'll do a bridge loan on the house they're going to sell, and they give them 6 months to do it, and then they'll give them another 6 months if they need it. And I think they charge like $1,000 to do it.
Okay.
So it's a lot better. The other nice thing about it is the rates are lower. I think they're in the 7s and 8s right now. They were a lot lower when rates were better, but that's still like, you can't find a bridge loan for that. And they do both at the same time. I've done several of them. You know, the thing about bridge loans and any of those things is that they have to qualify, right, with the new bridge loan payment, because it's interest only on whatever they take. So it's interest only on that. They still have their mortgage payment, and then they have the new house payment. So not everybody's going to be able to qualify for all that, but lots of people can. So when they do, it's a great option. I would say too, it's still pretty much a buyer's market. So other than the stress of having to time it, you know, just do a contingency purchase is okay. I mean, you'll get those through. It's not as easy, but it's still out there and people are doing them. And I always recommend, you know, trying to get a couple weeks to rent back at the current home, or maybe even up to a month if you can get it. And then that way the customer has time to move out and then, you know, into the new house before the new owner takes over. So it's a little less stressful if it all has to happen on the same day for them.
Right.
Yeah.
Storage.
So, yeah. So it's really important about the dates and things like that.
Okay. Thank you.
Yeah. But if you have anybody looking for, you know, to pull equity from their home to put down on the new home, we definitely do those. And then sometimes people just do, maybe they have 5% down, maybe they have enough to put down. They can do the loan. And then when they sell their house, they can do what's called a recast. And basically on a conventional loan, you can do them, and they can say, hey, I have, you know, $300,000 here. I want to make a principal payment and I want to recalculate, or they call it recast, my payment based on that lower balance. And so without refinancing, they can go in and they charge them maybe $400 or so to do it. And they'll redo their payments based on the lower loan amount. So that's something that other, you know, people can do as well.
Okay.
Yeah. And that works out nice for people. Big thing is you don't just send the money in, then ask. If you just send the money in, you just have a lower principal and you're saving money, but your payment doesn't change. So you have to call them and tell them what you're wanting to do with the money. Yeah.
Okay.
Yeah. And you can do that on conventional loans. They don't do it on any of the other loan types.
Okay. Thank you.
Yeah. Well, always here if you need me. Jessica as well. We appreciate you guys joining us, and it's recorded. If you guys, you'll get the link later if you want to share it with anybody or go back and reference it or anything. If you get bored and can't sleep at night, I don't know, whatever you want.
It's also always on Andy's website. So there's always that good news. You can go back to the old ones. Yep.
Yeah, all the old ones are in there as well. Well, so good to see everybody. Appreciate you guys joining us today.
Thank you all. Have a great day. Take care.
You too. Thanks.